Hello, everyone. I see we have people funneling in. I hope everybody has a good start to their day so far. We have a great presentation for you today. I'm going to give everybody a few minutes to be able to connect. And then once I see it starting to level out, I'll kick things off with our introduction and get to the meat of the presentation. Hope everybody's doing well. And feel free at any time throughout the presentation to use the chat or Q&A function through Zoom to ask questions, make comments. I'm going to give another minute or two for people that are still connecting, and then we'll kick things off. So I appreciate everybody's patience. Just another moment or so. All right, that should be plenty of time. So we'll get started. Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan and would like to thank you all for joining us for today's webinar, Earn Passive Positive Cash Flow and No Taxable Income with Mark Keener. As a quick note, please be aware that Mark will be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I'll be more than happy to help. And without further ado, I'll pass the controls over to you, Mark.
Okay, thank you, Will. And excuse me. Let me first welcome everybody here on the West Coast. We're just finishing coffee. I believe on the East Coast, folks are breaking for lunch. And if there's anybody from Europe, happy hour or good evening to you as well. Well, first off, it's an honor to be on the webinar to talk about a topic that got my attention very young in my career in terms of, getting involved in the world of investment. Previously, I started my whole career in the world of public accounting. I was a CPA for many years, and as a result, it gave me some insights on things about financial sharing or financial information that kind of transformed how I thought about how I wanted to spend the rest of my life. And I took a class. One of my first accounting classes was learning about this concept called depreciation, which we'll talk about a little bit later. And it just became a real big eye opener for me with regard to, investing in commercial real estate. So we're going to cover some things here with regard to, putting yourselves in a position. Some of you may already be in a position where you're actually, taking advantage of the tax laws that allow you to, in the real world, generate positive cash flow. But when it comes time to file your tax return, you're actually getting a schedule that shows a loss. So it may not have, no income tax impacts on the real world cash flow that you actually made. So come talk a little bit about who we are as far as a company, international partners. I think it's always important to give a foundation about understanding wealth principles as we see them, and then also, what a typical deal is that we put together for our clients. Every deal that we've done has involved people who are using their funds from their self-directed IRAs, and I commend you those who are on the line who are either doing it or are interested in learning how this whole process works. Then we're going to take some time to talk about this whole notion of positive cash flow and no taxes, and then a little bit about the role of investors with our company, and then also just finish up with a future outlook on multifamily commercial real estate and why we love that space that we operate in. So let's so that we're not total strangers here, a little bit about international partners. First and foremost, we're a commercial real estate investment company. We're not developers. And what I mean by that is that we invest in multifamily apartment communities strictly, mostly garden style, class A and B apartments. And sometimes we do value add, and it could be a class C properties as well. They're typically 100 units or more, located in growth areas that provide exceptional appreciation and double digit cash on cash returns for our investors. Well, despite all of that, in terms of the billboard way that you may see international partners, what's really the underlying current about what drives us is that we're simply using one of life's necessities, shelter and rental shelter, to be a vehicle to help individuals create, passive income and also contribute towards their way to increase and build up their passive income. And for our institutional clients, we want to make sure we're always meeting their target returns, actually exceeding their target returns as well. So it's really more about a lifestyle. I want you to think about this in the terms of, if the income that's coming into my life, I am able to structure it in a way that it doesn't require my active participation of time and effort. I'm sure we all would sign up for that. Okay, so in terms of our experience in this business, again, numbers are always relative. These are numbers that are done in some of our markets, which are typically second and third tier markets, as opposed to the major gateway cities like here in San Francisco, San Jose, Silicon Valley area, or New York or Chicago. Had these numbers been done there, and those numbers, the prices that you're seeing, or the numbers you're seeing, would actually be about 5 times what you're seeing. But in any case, we've had some experience in multifamily activity for a number of years here. And in terms of how we performed, this is sampling of how some of our assets have performed. Kind of looking at column A, what we paid for it, 2.7, now 9.5, there should be 9 million valuation. And then also its appreciation year over year, averaging 13%, and cash out 4 times, and then also overall internal rate of return in the 26% area. So that's kind of a typical what we aim for. And also too, we're not fix and flippers, so to speak. We are long-term hold investors, and our current goals that we're working on for the next couple of years is to build up our portfolio to 11,000 plus apartment homes, and then also the valuation in the markets that we're looking at generates a value of 1.5 billion. Of that amount, $1 billion of that will be financed, and so that means there's a $500 million or $500 million that remains to be raised by investors that will partner alongside of us. So our investment philosophy, and again, wanted to stress this from the standpoint of, every time people say location, 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 granted that's important, but we've come to understand that a lot of successful investment involves understanding the movements and migration of people as where certain things are going in a more broader sense of society. So we look at job growth as our number one indicator, what markets rank the highest in terms of job growth. We look at population trends in terms of where people, again, where areas of population is growing exponentially. And then is it a market that has a strong demand for rental housing? Also, looking at the migration trends of people. We have a range of people from millennials, I guess actually Gen Z, to baby boomers, and even some of the silent generation that was pre-baby boomers. And also important to us is making sure that we're looking at assets that are on paths of progress or growth corridors, sometimes leading out and around the first tier gateway cities that I talked about earlier. So in addition to, we have holdings in Texas, we're looking to expand into the Carolinas and the Southeast, have some holdings in California where we're based also, but in California, again, it's in more of the Central Valley as opposed to Los Angeles or San Francisco. And also too, we understand that sometimes people think that, how do I get involved in investing in large scale apartments? I'm just one person. Can I qualify for a loan? Well, a lot of that, all those kind of things, we handle all that heavy lifting, so to speak, in terms of doing this for decades and having a full-time team that looks at these things. So we're looking to partner up with people who have an interest, yet they may lack the time and experience, and that's where we create a bonding relationship to help you get into this game. So again, as I mentioned, this is strategic long-term investing. We typically have 5-year hold periods, and at the end of that 5 years, there's an option to exit out or to continue to stay on indefinitely. Some wealth principles that we like to talk about with regard to, we're not just looking to get people to write a check to us or what have you. We're looking to really build a long-term bonding relationship that people invest with us because they want to, not because they feel they have to, or their arms being twisted. And a great book, some of you may have read it or heard of it. If not, I strongly recommend it. It's called Think and Grow Rich by Napoleon Hill. And in reading the book, several times, there's a quote that stuck out with me that sort of got my attention in terms of, most of us focus our thoughts and energies on not being poor instead of focusing our thoughts and energy on becoming wealthy. And to me, it just seemed like, it's a simple flip of the switch in terms of how we think and how we've been oriented in life in terms of, well, why not think about building abundance as opposed to thinking, operating in a world of scarcity. Alongside of that too is Robert Kiyosaki, the author of The Rich Dad Poor Dad, is known for illustrating this diagram to help people understand about financial literacy. And these 3 little diagrams here, the cash flow, the poor, the middle class, and the rich. And let me just say that these illustrations have nothing to do with the amount of income somebody makes. It's more about the mindset that a person does. So there are people who could be making millions and maybe even billions, but they could have the mindset of everything that they make, they're going to spend. So really they're operating in the category of the cash flow of a poor person. In the middle class category, again, they may make a lot of money, but sometimes they're spending it on things that they may think that are assets when in fact they're not. But and then there's folks who may have modest means, but what they're doing also is the money that they make, they're buying it, spending it on assets that do 2 things. Number one, they generate a positive cash flow. And then secondly, they also appreciate in value over time. And again, that's the distinction that's important to keep in mind, that people say, well, isn't my house an asset? Well, it may be appreciating in value, but is it generating any cash flow? In other words, does it generate cash flow to pay the mortgage, to pay the insurance, to pay the taxes? And obviously, the answer to that would be no unless you convert it. So just keep those things in mind. And again, I think that's one of the foundational things that we want people to understand, because again, when it comes to what we do, you'll understand that we're helping you to get your cash flowing in the pattern that the rich does. And then the last point on this is that another quote or another book that Robert Kiyosaki wrote called The Cash Flow Quadrant. And again, this is just highlighting the difference between linear income and passive income. So if you're an employee or self-employed, typically your income is linear, meaning you go to work, you get paid. If you don't go to work, you don't get paid. And passive income, again, is you're part of a system where you're making your income is coming into you whether you work or not, and that's either through a business or being an investor. And if you're thinking, well, how does this relate to, multifamily apartment investing and my lifestyle? Well, you continue to run your business or perform in your job, but you can also allow your money to work in the B and I quadrant in terms of investing in these types of assets that generate some passive income to you. And then the last point on all this is just, kind of a gift to everybody if you haven't already heard about this concept of called a wealth ratio. What it simply looks at is looking at and doing an assessment of how much passive income do I have coming into my life. And passive income is simply defined by things like dividends, interest, royalties, obviously uh, real estate. And so income producing real estate. And so if your monthly expenses of necessity are say $10,000, that's housing, transportation, food, all the different insurances, health insurance, et cetera. And your passive income is 1,000, well, you have a wealth ratio of 0.1. Well, what we want folks to think about, or maybe strive to, if you're not already there, and some of you probably already there and past that, is to how about having your wealth and your assets generating for you at least $10,000 a month, basically matching your expenses, and as a result, you have a wealth ratio of 1, and even going beyond that, multiplying that to be a 2x or a 3x and so forth. So anyway, that's all on the wealth principles. We're going to shift gears to talk about a typical deal in terms of that we typically invest in. So again, as I mentioned earlier, apartment size 100 to 500 apartments in our portfolio. Our highest is 336, and the other end we have some that's 18, but typically it's in the 100 range. Valuation about 10 to 50 million dollars, and again, as locations, we look for the markets that rank highest in terms of job growth, population growth, and demand for rental housing. And again, we're looking at 2 and 3 story walk-up garden style apartments. Being out here in San Francisco when the pandemic hit, there's a lot of high rise, 30, 40 story apartment communities that because of the dense living arrangements, and COVID, folks just bolted out of those areas during the pandemic, and a lot of it hasn't returned. In the case of 2 and 3 story walk-up garden style apartments, there's a lot more space, a lot more spreading around, and we weren't nearly as impacted as others in multifamily because of our focus on garden style apartments. All our structures are set up as a LLC, and investors are a member in the LLC. Because it's also direct investing, meaning this is not a real estate investment trust or a REIT. It is direct investing, meaning that you have a proportionate share of ownership in an asset at a specific location. And the other thing that we do is, as far as direct investing, is that your money does not go into a pool and get spread out, invested over multiple properties all throughout the country. It's in a specific location, a specific address. And then investment minimums in the US, 100,000, in Europe, 50,000 euros, and again, typically a 5-year hold period. So what do we shoot for in terms of getting returns for our investors? Well, using an example of 125,000 invested, 5-year hold period, and a target of 10% cash on cash return over that 5-year period, and an equity multiple or gross equity multiple of 2.5 times, meaning that 125,000 will grow at the rate of 2.5 times over that 5-year period. This is what it looks like in terms of real numbers. So 10% a year. And again, a lot of times what will happen early on, there could be a situation where maybe in the early years it's 7 or 8%, and then in the years 3 and 4, it may be 13 or 14%. So, but overall of that 5-year window, we're aiming to at least average 10%. So you're looking at 12,000 a year, 1,000 a month, 62,000 over 5 years. At the same time, what's happening with your principal or your equity that you invest in, it's also appreciating in value. And so that 125 at the end of that 5-year period will be worth over $300,000. Subtracting out your initial investment, you're looking at a net of over nearly 200,000. So when we add in your two returns, again, your cash on cash return, as well as your equity from the potential sale or capital event that would unlock that equity, a total return of $250,000, which works out to be about a 20% return on investment. So again, this is just an example, and again, actual results will vary in terms of just general disclosures, but I wanted to give everybody some sort of understanding about what we target for when we're doing investments. All right, so here's the headline topic for today: cash flow, no taxes. So as I mentioned earlier, in a prior life, I worked. I'm a CPA, worked in corporate America. Was at the ranks of being a controller, chief financial officer, understanding the accounting and the financial part of underwriting or doing feasibility, investment feasibility, comes pretty straightforward to me. And I'm sorry, I hope for those folks who don't like numbers, I've distilled this down in a way that if you don't like numbers, you'll like this example. If you're the kind of person that loves numbers, then you're going to love this example in terms of simplifying it. So in a rental property, and this is taken from, these are actual numbers taken from one of our properties. You have rents, you have expenses. What's left over is what's called net operating income. It's a very important key indicator, key performance indicator in commercial real estate. It's similar to EBITDA in the traditional business world. So in this case, both for book purposes and tax purposes, the net operating income is the same. Now, after net operating income, there's debt service, that's paying the mortgage, and every time we make a mortgage payment, part of that is paying interest and part of that is paying principal, paying down the debt, paying down the mortgage. So in the real world, we have to pay the full mortgage payment of interest and principal, but in the tax world, we can only deduct the interest portion. So you'll see only 200,000 is being deducted for tax purposes. Now, one more step here. And so again, taking the net income both from the real world as well as the tax world, you see the tax world, the net income is higher than the real world. But what happens now is this thing called depreciation. And in the Internal Revenue Code, the IRS code here in the United States, it says that when you buy something, over time it is deteriorating, it's losing value, you have to do repairs and maintenance, and which is true, but on the flip side of that, it's also appreciating in value and growing in value. So you have this sort of for tax purposes, you get the ability to apply depreciation and also amortization. And let me just explain too, depreciation and amortization are not things that you have to pay out of your pocket. It's not a real drain on cash flow. It is what we call a phantom expense or a book expense. And so, as you'll see in this illustration, that that 174,000 of net income, we also had some capital expenditures that are going to be depreciated. So we had to put money out for that. So at the end of the day, $105,000 was paid out as cash distributions, real world, that hit the bank accounts of our investors. But on the column dealing with taxes, again, because of depreciation and amortization, the taxable income was a loss. It was a loss of $5,000 basically. And then in this particular case, this asset we've had in our portfolio for over 20 years. And in the IRS code, there's something called step-up basis depreciation, which means that the basis 20 years ago, or the value 20 years ago compared to the value now, is there's a huge difference, a huge appreciation in value. So what we're able to do for depreciation purposes, we're able to use the valuation today's value rather than 20 years ago. So that also adds another component for showing a tax loss. And so when you add up both the depreciation as well as the step up depreciation, we're looking at a $70,000 tax loss that gets filed with the IRS so that this asset lost money as opposed to making money. Now, how does this relate to you as an individual? Well, let's just say that you have a 10% ownership stake in this particular asset. Well, then you would receive a tax form. It's called a K1 or partners share of pass-through share of income or loss. And so in that K1, if you own 10%, then you would show a $7,000 loss that you can use and then incorporate with the rest of your tax files. Now, again, we're not tax experts. Always consult a tax CPA or professional in these matters, but I'm giving you an illustration of the principle of how this works. And so a lot of times folks who understand these rules are taking and applying this in a way that they can, again, in the real world, make $105,000 positive cash flow. But when it comes time to file taxes and prepare your tax return, none of that is taxed because of depreciation and amortization that kicks in that generates a taxable loss. So again, for those who, numbers aren't your cup of tea, hopefully this example was, simple and broad enough and covered the theory as well as the practical application. And for those of you who, are very comfortable with numbers, I know I've maybe been simplifying this a bit, but again, the point is that, this is a concept that is very real, very applicable, and anybody and everybody can definitely take advantage of it. So last little couple of points here, and then we'll open up for whatever questions that may have come up during the webinar thus far. So we also, when it comes to building a relationship with our investors, as I mentioned earlier, we want people to understand, having some reason and rationale as to why they're doing what they're doing. It's yes, you don't want to get great returns, but really we kind of look at this as more of you're making lifestyle decisions in terms of, if I work 5, 10, 20, 40 years, will I be in a position where I'm not feeling I have to live on a fixed income, but over this time period, I've done things to allocate some my resources to acquiring assets that generate passive income, so that I have some more choices in life in terms of not having to worry about having a fixed income or paycheck to paycheck. Also, too, when it comes to our deal structures, or our investors are passive, we're active as the owner, operator, sponsor. The income is passive; it's paid out quarterly, and typically in every transaction we've done, your cash contribution is only one time, meaning that if we're having to do renovations or upgrade a property or we're buying something, we typically cover those costs through borrowing against the property rather than having to come back to our investors doing what we call cash calls for additional capital. So they typically, again, it's a one-time cash contribution only. And then lastly, in terms of building a relationship or staying connected, on our website, there's a profile that sort of identifies, what are your goals? Is it cash flow? Is it tax deferral? What's your current allocation in terms of, are you a lot of money heavily weighted in stock? You want to diversify some into real estate. Also, too, what is your investment threshold? As I mentioned earlier, outside the U.S., it's 50,000 or euros or whatever. Inside 100,000. And on this profile, you would sort of indicate, this is kind of my range of what I'm looking for to invest. And we go out looking for acquisitions that will meet our target goals. And when we find something that we've vetted and we've made a determination, we're going to make an investment, with or without folks, that we're going to send out a subscription or an offering to say, here's an offering that you have a chance to participate in. And if you subscribe to it, then that starts the long-term relationship. And then, this whole space is about multifamily housing. We've gone through the last year and a half or so with a very stressful economy, inflation, interest rate hikes, supply chain issues, and despite all of that, forecasts that was done, 3 years ago said that, even at the present rate of building, there's still going to be 4 million apartments that are going to be needed. And what's also happened as a result of the economy, the fact that, the price points for purchasing a home have or the buy-in for buying a home has changed because of interest rates being higher. So you're going to need more income to qualify for a loan because of the higher interest rates. So that's knocked a whole lot of people out of the ability to enter into the housing market. And what it's done is it's continued to support and drive up rental income and demand for rental housing. Another study that was updated again by the National Multifamily Housing Council again says that we're still 4.3 million apartments going to be needed to keep pace with what's going on with people and demand for rental housing. So again, life has three necessities: food, clothing, and shelter. And so we like being in the space of shelter because it's always going to be a need for it. And let me just wrap up with some wise words from the Oracle of Omaha, Mr. Warren Buffett. And he, is well into his 90s, and he's still enjoying what he does and still works and continuing to help other folks, benefit from some of the principles of passive income, et cetera. But quote that he said is that if you don't find a way to earn money while you sleep, then you'll work till you die. And obviously, we all have to have that eventuality. But the whole point being here is that wouldn't it be nice to be in a position where you can also earn money while you're sleeping and enhance and improve the lifestyle that you have while we're here. So in wrapping up, we look at three things that, to ask, is there alignment of interest in what we're doing, and prospective investors. Our role as a sponsor is to identify high performing assets and serve as the operator. As mentioned earlier, our goal is to, we're working towards 11,000 apartments. And then with regard to our clients' goals, again, we're about helping them build their wealth ratio, build passive income by partnering up with us in doing so. So how to stay connected or get informed? The PIN or the QR code there or the website link allows you to just provide basic information about name, email address, and once a month we send out educational things. The second QR code says complete an investor profile. That goes into a little bit more information for somebody who's not just curious, but they're serious and they're ready to make some investment moves in the in the coming months. And that's something that we also ask people to complete. And in terms of just another disclaimer with regard to the investment offerings that we provide, these are private placement offerings, meaning that we don't register our investment offerings through the SEC. There's an exemption that allows us not to do that registration when we are investing with accredited investors. And so all our deals are structured in a way to accommodate accredited investors. The SEC defines that. I'm not going to go into details about that right now, but when you do complete a profile, the information to check the box if you're accredited or even if you're non-accredited, there are some thresholds there that can allow you to invest even as a non-accredited investor. So I think we're going to I think we wrap that up here for me.
Perfect. So we do have some questions coming in. Thanks for all the great information so far, but we do have some questions coming in. To get started, Charlie asked, please explain how recapture works at the end of the investment.
Sure. And again, I'm not a tax expert, but what recapture is in the IRS code, a way of saying that, okay, you've depreciated this amount and and now you're getting ready to sell an asset. So some of that depreciation that you've taken as a deduction, you're now going to have to recapture some of that, or that depreciation is going to be added back to the basis. And so the losses that you may have taken earlier, some of that may feed back into adding to the basis that you, or adding to or taking away from your loss or gain on sale. So recapture means that some of that depreciation you deducted earlier now have to maybe added back. And it depends on when you do it too. Obviously, like I said earlier, we're a long-term hold investors, and so 5-year horizon, or you can go beyond that if you like. And we haven't had any situations where any of our clients, we've had situations where we had to factor in a recapture. But again, it's a way of the IRS says that, hey, we've given you this generous deduction of depreciation or depletion, but now that you're selling the asset, then some of that that you've taken as a deduction is going to be added back in determining what your capital gains, your taxes on capital gains will be. And Will, are you still there?
Oh, sorry, I was muted while you were answering the question, but thank you for your answer, Mark. Thank you for the question, Charlie. We do have two more questions that came in while you were wrapping up the presentation. If anybody else has any questions, please put them in the chat or Q&A function now while we still have Mark's time. But to get to the two questions that were asked while you were wrapping up, one question comes in from Greg. He asks, is this something based upon the tax treatment that is typically done in a non-IRA investment account?
Yes.
Okay, perfect. Thank you. Another question comes in from Gary. He asks, I apologize if I missed it. Is this tax loss every year correct, or is this a one-time tax loss?
It's every year.
Okay, so it's annual.
And again, it's every year. Again, every year we have operating income, operating expenses, and so it's done every year.
All right, perfect. Thanks for that answer, Mark. Thanks for the questions, Greg and Gary. Any more questions while we're still live and we have Mark with us here? Mark, did you leave contact information if anybody watching this recording or has questions after the fact that they weren't able to think of now that they can reach you at?
Let to screen sharing if I can here. And the very last slide, I can get it to operate here. Bottom line is that I didn't include contact information, but I can.
You did have those links.
Yeah, those links will definitely get you connected. But my yeah, the website is, let me pull that slide up again.
No worries. Yeah, it looks like nobody has questions at the moment, which is understandable. You did a very thorough presentation. But some people who might be watching this recording when it gets sent out may have questions that they want to follow up with too. So I'd like to make sure that everybody can get their questions answered. And as always, if anybody has any questions about how this works with a self-directed IRA or any questions regarding self-directed IRAs, you can always contact us. Our website is www.camaplan.com, or you can shoot us an email at info@camaplan.com or wmucker@camaplan.com, and I'll be happy to help.
Sure. And just to simplify it, as far as, reaching me directly, I'm Mark, M-A-R-K, and then at the extension IPLLCinvestments.com. Another way to reach us is also just investor at IPLLC.com. And in terms of just our general office phone number, it's area code 510-444-7810. Again, 510-444-7810. So, but a lot of this information I just shared is on our website, and the website is, again, just IPLLCinvestments.com.
Perfect. Thank you, Mark. We do have one more question that came in from Rosalind. She asks, I'm not sure of the size of your organization. Do you have key man insurance?
We don't have key man insurance. Most of our top level folks who handle acquisition, capital raising, we're structured such that they're all independent contractors as opposed to employees. That may change in time, will change in time. And the people that we work with outside of our immediate team, whether it's brokers, lenders, again, property management companies, they are third party or independent to us as opposed to being under the umbrella of international partners or being employees of international partners. And a lot of this by design in terms of, keeping overhead low and to a minimum so that we can still be effective and execute and do transactions and deals. But with regard to, the top level people, as we're structured right now, where they're members in our LLC, or they have members in the LLC in an operational way, and then they are paid as independent contractors.
All right, perfect. Thank you for that clarification, Mark. Thank you for the question, Rosalind. And yeah, thank you everybody who joined us today. Anybody who's watching this recording in the future, if you have any questions, please refer to the contact information Mark left earlier or the contact information I left earlier. If there are questions regarding self-direction, I'm always happy to speak with people about self-direction and answer any questions. But again, thank you, Mark, for lending us your time and presenting this information. And thank you everybody who joined us today.
Yeah, and thank you, Will, and thank you, Brad. Have a happy New Year.
Happy New Year. Take care.